Hey there, fellow investors. This is Michael's Fortune Bread back with another exciting video. Today we're diving deep into the world of the one and only Warren Buffett. You know him, you love him, the Oracle of Omaha himself. This guy's been a legend in the investment game for decades. But what's his secret sauce? How does he keep crushing it year after year? Well, buckle up because we're about to break down Buffett's billion-dollar secrets. So grab your coffee, get comfortable, and let's unlock the secrets of the Oracle of Omaha together. We're talking decades of market-beating returns. It's not about luck, folks. It's about a system. A philosophy that stood the test of time. Think about it, 50 years of averaging over 20% returns. That's unheard of. That's turning $1,000 into millions. So, what are we waiting for? Let's jump right into the nuts and bolts of Buffett's strategy, starting with his early days. Now, every legend has a beginning, and Buffett's story starts with a rather unusual strategy, cigarette butt investing. Sounds kinda gross, right? But stick with me here. See, back in the day, Buffett was all about finding these deeply undervalued companies. Think of them like discarded cigarette butts. They might have one last puff left in them. These weren't glamorous companies, mind you. But Buffett, he saw something others didn't. He'd dig deep into a company's financials, looking for hidden assets, untapped potential. That's how Buffett started building his empire. Now, finding these cigarette butts wasn't easy. Remember, this was before the internet. Before fancy algorithms. Buffett was doing this the old-fashioned way, reading tons of financial statements, researching companies, analyzing data. He focused on a key metric called net working capital. Basically, he wanted to see if a company's assets, when liquidated, would be worth more than its stock price. This relentless pursuit of value is what set Buffett apart from the pack. He wasn't swayed by hype or speculation. He stuck to his guns, focusing on the fundamentals. And slowly but surely his wealth began to grow. But it wasn't all smooth sailing for the Oracle of Omaha. Even Buffett made mistakes. One particular investment in the textile industry taught him a valuable lesson. He found a textile company called Berkshire Hathaway trading for a seemingly irresistible price. It seemed like a classic cigarette butt opportunity, but there was a problem. The textile industry was in decline. Buffett's investment in Berkshire Hathaway turned out to be a dud. This experience was a wake-up call for Buffett. Now, Buffett's investment in Berkshire Hathaway, it wasn't just a bad call, it was a turning point. He poured money into this textile company, figuring he could squeeze some profits out of it. Sounded good on paper, right? But the textile business, it was a sinking ship. Competition from overseas, changing consumer tastes. The whole industry was falling apart. And you know what? Buffett held on too long, trying to salvage something from this bad bet. He later admitted this was a huge mistake. Cost him a fortune. Taught him a lesson he'd never forget. Sometimes, even a cheap company is a bad investment. He realized he needed a better way to pick winners. This Berkshire Hathaway debacle, it made Buffett rethink his whole game plan. He realized that chasing after those cigarette butt companies, the ones on their last legs, yeah, that wasn't a sustainable strategy. He needed to find businesses with staying power, companies that could grow and prosper over the long haul. He needed quality, not just a bargain basement price. He started looking beyond the numbers, trying to understand the underlying business, its competitive advantages, its long-term prospects. He wanted to own a piece of the best companies in the world. This is where Buffett's investment philosophy, the one that's made him a legend, really took shape. He called it value investing, and it boiled down to three key principles. First, find great companies. Not just any companies, mind you, but businesses with strong management, durable competitive advantages, and a clear path to future growth. Second, buy those companies at a discount. Buffett was a master at spotting undervalued opportunities. He'd wait patiently for the market to freak out, to irrationally punish a great company, and then he'd swoop in and buy it on sale. Third, and perhaps most importantly, hold those companies for the long term. Buffett understood that time is the investor's best friend. This, my friends, is the essence of Buffett's value investing philosophy. Alright, so Buffett ditches the cigarette butts and decides to focus on wonderful companies. But what makes a company wonderful in Buffett's eyes? Well, he's got a pretty specific checklist. First off, he wants to see strong management. He wants leaders who are smart, honest, and shareholder friendly. They gotta know the business inside and out, and they gotta be committed to creating value for their investors. Second, he looks for companies with a durable competitive advantage. This is huge for Buffett. He calls it a moat, and it's basically what protects a company from its competitors. And finally, he wants to understand the business. If Buffett can't figure out how a company makes money, he won't invest in it. Now, let's dive a little deeper into this whole moat thing. This is central to Buffett's investment philosophy. He's not interested in companies that are just doing well today. He wants companies that are built to last. Think of it like this: a moat protects a castle from invaders. Similarly, a competitive advantage protects a company from its rivals. It allows them to keep prices high, to control market share, and to generate strong profits over the long term. There are different types of moats. Some companies have a brand moat, like Coca-Cola. Other companies have a cost advantage. And then there are companies with network effects. So, Buffett's found himself a wonderful company. It's got great management, a wide moat, and a business model he understands. That's why Buffett's always looking for a bargain. He's like a patient hunter, waiting for the perfect moment to strike. When the market panics, that's when Buffett starts buying. Let's talk about one of Buffett's legendary investments. We gotta start with Coca-Cola. A classic Buffett play, strong brand, simple model, consistent profit. He started buying in the late 80s. He saw even more potential, loved the brand recognition and global reach. And he was right. Coca-Cola's stock price soared, a testament to his philosophy. Now, not all of Buffett's investments were slam dunks from the get-go. Take American Express, for example. Back in the 1960s, the company got hit by a scandal that sent its stock price tumbling. Everyone was running for the hills, but Buffett saw an opportunity. He knew that American Express had a strong brand and a loyal customer base. He figured the scandal was a temporary setback, and he was willing to bet big on the company's ability to recover. So he loaded up on American Express stock, and guess what? He was right again. Now, for years, Buffett stayed away from tech stocks. He just didn't understand them, and he wasn't comfortable investing in what he didn't know. But then something interesting happened. Apple came along. Now, Apple wasn't some fly-by-night tech startup. They were a well-established company with a dominant market position and a loyal customer base. They were making products that people loved, and they were generating tons of cash. Buffett saw the value in that. Today, Apple is one of Berkshire Hathaway's largest holdings. Now, we've talked about finding great companies and buying them at the right price. But there's another crucial ingredient to Buffett's success: patience. This guy's a master of the long game. He doesn't get swayed by short-term fluctuations or market noise. He's content to let his investments compound over years, even decades. He understands that real wealth isn't built overnight. It takes time, discipline, and a willingness to ride out the inevitable ups and downs of the market. If you are patient, you can focus on the bigger picture, on the long-term growth potential of your investments. One of Buffett's greatest strengths is his ability to tune out the noise. He's not swayed by the latest headlines, the hot stock tips, or the panicked chatter on CNBC. No offense. He knows that most of that stuff is just noise. It's distractions that can lead you astray from your investment strategy. He focuses on what matters, the fundamentals of the businesses he's invested in. He's not checking his portfolio every 5 seconds. He's thinking about where the company's going to be in 5 years, 10 years, 20 years. It's not always easy, but it's essential for long-term success in the market. So, we've seen how Buffett became one of the richest guys on the planet. But here's the thing about the Oracle. He's not obsessed with money. Don't get me wrong, he likes making it. But he also believes in giving it back. And I'm not talking about a few million here and there. Buffett's pledged to give away the vast majority of his wealth to charity. We're talking billions upon billions of dollars. He's teamed up with his buddy Bill Gates to create the Giving Pledge. He's proving that true success isn't just measured in dollars and cents. It's measured by the impact you have on the world. So, there you have it. The wisdom of Warren Buffett. From cigarette butts to Coca-Cola, from patience to philanthropy, this guy's a walking, talking investment encyclopedia. First off, invest in what you understand. Don't chase after the latest fad or the hottest tech stock if you don't get the business. Stick to companies that you can wrap your head around. Second, be fearful when others are greedy, and greedy when others are fearful. And finally, be patient. Rome wasn't built in a day, and neither are fortunes. Focus on the long term. Find great companies, buy them at the right price, and let your investments compound over time.